I prefer the latter scenario. I'd rather have the market break resistance to let the market tell me the bulls are really in control. So the way I would look at it, if the market breaks resistance, then we can go long. Okay. If it breaks support, we can think about selling. This is really what momentum trading is all about. Okay, here we have a hammer and a bullish engulfing pattern. How about from a risk-reward perspective? What do you think? Looks great. Looks excellent. Looks fine. Okay. If you do a trade and it doesn't work out within a certain amount of time, then get out. It's called a time. We're going to look a little bit at stops later on. I talk a lot more about stops in my advanced DVD, but we'll talk a little about it today. It's called a time stop. You don't want to commit capital to a trade that's not working out. So here we have the bullish engulfing pattern, and it's just meandering. This is an intraday chart, but I don't know if it's days or whatever this period is. But this is a trade I would not want to stay in. The general idea with the if-then also, if you do a trade and it doesn't work out, then get out. Whether that means a time stop if it doesn't work out within a certain amount of time, or if you're buying, let's say you're buying on the bullish engulfing pattern, and then you're looking for a particular target, and it gets maybe within a few ticks of it and then starts pulling back. Keep in mind, a support and resistance area are not exact. A lot of people forget about that. So even if you get to within a few ticks of support and resistance, you could think about getting out of the position. But the general precept, if the market does something, then we react according to what the market is telling us. What's that? Okay, the question is, doesn't this look like a continuation pattern? So after the bullish engulfing pattern, the market moves sideways. And once it breaks that sideways moving action, we've broken out of a horizontal trading band. Okay, then we can think about going short. Very often when the market's in a consolidation band, and this is another reason you should be out of the position with that bullish engulfing pattern if the market isn't moving, it doesn't move up soon, because if you have a downtrend and the market starts moving sideways, theoretically, they've done studies, this is years ago, I don't know if they've updated them, and this is in the equity side, I don't know about, I don't think they ever did this in the Forex side, but the odds favor a breakout in the direction that the market had before the lateral band. So in other words, what was the direction between before the box range? After that bullish engulfing pattern, what was the, when the market moved in the box range, what was the prior direction? Down. The odds slightly favor a downside breakout, yes. So that's
can I say that the risk rewards, the resistance area is only for entry level. Once you're in the ticket position, you can really ignore that the risk reward area. Resistance was a area. Once you are in a position, and then you should look for a time frame, whether how long you want to stay in a position. Right.
The question, he brings a great point, that when you have the position, you're looking at the risk reward when you first put on the position, but we should be thinking about a time frame also. How long are we going to give to get to that target? Right, exactly.
They repeat themselves over and over. So you do back testing. Is that true with the Forex? Can you look at the pairs and say they react this way?
The question is, can you test the candles, essentially, in the Forex market? And the only way I would suggest doing that is using them in addition to what you normally do. I would never say buy on every bullish engulfing pattern. Okay? Why? You have to define the risk reward. You also should look if the bullish engulfing pattern or the hammer is confirming another support area. So this is, again, the biggest misuse of candles. And those who try to backtest it don't do it right. I've seen articles in Stocks and Commodities magazine. The candles work really bad. They work really well. It depends on the testing. It doesn't matter. They're not testing them right. Trading with candles in isolation is, like the Japanese say, like leaning a ladder against the clouds. Okay, there's nothing substantial. You can't just use the candles. You have to think about risk, reward, money management. The triad we'll look at later. Candles, Western signals, and money management. Candles is just one leg. Yes? Mm-hmm. Oh, yeah. Oh, yeah, the hammer and the bullish engulfing pattern is a great risk reward. I would be doing this trade. The point is that when it was by trading sideways for such a long time, I wouldn't be committing capital. I wouldn't keep the capital in there.
So at that point, since you have the bullish engulfing and you have the counter, why wouldn't you make the entry right there?
I would. I would. Right. There's also something called a time stop. If the market just meanders, you're holding, your capital is being committed there. There's other markets you could probably much better risk, I should say better risk rewards, much better trading opportunities. You don't want to tie your money up on a market that's doing nothing here.
Much downtrend.
Mm-hmm.
Do you think just that pattern, candle pattern, confirms a shift in psychology?
Okay, because the market is in such a big downtrend, does these candle signals show a shift in psychology? One thing I would do is, getting back to her question about a daily chart, I would see if this hammer or an engulfing pattern is confirming a support area in the daily chart. Okay, we'll look at later, for those who trade intraday, take a daily chart support or resistance and throw it onto an intraday chart. And then if you get a candlestick signal confirming that daily support or resistance, think about pulling the trigger. But my feeling is, because he had both a hammer and a bullish engulfing pattern, one confirming the other, then I would go long. If it was just a hammer, probably not. And we're actually looking now at money management strategies, the basics of money management. And when we look at the risk-reward, obviously one aspect of the risk-reward is, if we're defining the risk, we're defining our stops. So we always need to use stops. A question I was asked is, with the Forex survey, is how do you deal with false signals? Stops. Right? You don't know it's false until the market tells you it's false. Okay. There's always a price that says we're wrong. That's what stops are all about. The Japanese say it's better to bend than to break. And probably the way that people get blown out of the market is, the most common way is taking those huge one or two tremendous losses. And don't think that the market, well, on the equity side, the market makers, on the Forex side, maybe the banks, they're not going to be gunning for your stops. Don't worry about it. Unless you put them in an obvious area. I mean, if you put them at the zeros, you have like a support area at 122 in the yen. Okay. Everybody in the world might have a stop there, so they're going to be gunning for the stops, So what you should do is put it maybe 10, 20 pips under there, because that's as far, you don't know how far the stops are going to be taken out, but they gun for the stops all the time. So if it's a very obvious chart point, by obvious I mean a round number, think about that. They're not going to be gunning for your stops. They're just gunning for everybody's stops, because they know retail uses the round numbers. Yes?
Do you think that's part of the reason for the crack and snap?
Yes, definitely. Well, the question is this part of the reason for the crack and snap and falling off the roof, which techniques we'll talk about later? Yes, definitely. We'll look at that in a bit. And as smart as we are, remember one thing that's always, always true, that the market is never wrong, okay? Oh, yeah. Face it, yeah. Okay, here we have a bearish engulfing pattern with the with the red semicircle in late January. The market closed above it, so remember with the idea of stops. Okay, so the market closed above it. And if we're short, we would have been stopped out. Okay, question. What is that second red semicircle? What kind of pattern is that? Bearish engulfing pattern. So the question is, and the bearish engulfing pattern, the high of the bearish engulfing pattern was around 119.25 on the dollar yen. Okay, so where's your stop? Okay, 119.25, right? Right.